Hello there. Welcome to this Future of Private Investing webinar on profiting from property in a post-pandemic world. Where do the biggest opportunities lie? My name is Mitchell Labiak. I'm a property writer at Investors Chronicle, and today we're going to be talking about how savvy investors can navigate the property market. The real estate market has long provided investors with a reliable source of income, but the pandemic has changed many of our assumptions about the sector. At the peak of the pandemic, cities were empty, and this had a significant impact on the values of offices and retail property. Meanwhile, house prices have rocketed up thanks to a combination of the stamp duty waiver and people wanting a bigger home after having been locked inside for 2 years. Jump ahead to 2022, and house prices are continuing to rise, and we're now in a period of economic recovery, but it's one which, like so many other sectors, fears of inflation and the possibility of another recession loom large. So, in short, it's an interesting time for property and property investors. So to help us navigate these choppy waters, we're joined today by a panel of experts on the UK property market. So joining me in no particular order are Ranjan Bhattacharya, a property investor, developer and mentor, and the founder of succeedinproperty.com. We have Paul Mahoney, the founder and managing director of Nova Financial Group, Bindar Desange, award-winning author and property investor from femalepropertyalliance.co.uk, and last but not least, Ben Thompson, Deputy Chief Executive Officer of the Mortgage Advice Bureau. Welcome to you all. We'll be getting questions as we come in, so please do feel free to type those in and we'll try and get to as many of them as we can. But my first question is a rather open one to anyone who wants to take it on. We are hopefully in a period of economic recovery, which may or may not be hit by inflation. So bearing that in mind, how are the changes to the real estate market brought on by the pandemic set to affect the property industry in the coming year? Who wants to take that one first?
I think I can chip in a little bit. I think it's not so much the pandemic that is causing the problem. It is the economic measures that were taken to address the pandemic that are now causing the problem. And what I mean by that is the money printing, which we've all got to now pay for. So it's not that the pandemic or COVID prevention or masks or hand sanitizing, it's not that sort of issue. It is the impact of the measures that were introduced, which we are now all having to pay for. And I think we've all got to pay for it. You can pay for it through taxation, which is obviously very politically unpalatable to put out to the voter. The easiest way that governments seem to tackle to pay for all of this is inflation, because no one has to vote for it. You can say it's a problem that affects everyone in the world. But the issue for property investors is that inflation is running at a very, very high rate. Real inflation is much higher than headline inflation. And the issue is that everyone needs to do something to hedge against it and come out better. Otherwise, they're stuffed, really.
Ranjan, Bindar, what are your thoughts on that? I mean, is that the sort of biggest impact from the pandemic? Is the way inflation is going at the moment?
Well, the biggest impact is cost of living crisis that we're having, and really the impact of for everybody people's incomes are not rising. But yet the cost of living on everything, fuel prices and food, etc., and then the rentals, or the sustainability of the rents in the properties as well. How do you manage the tenants, etc.? So the inflation has a huge impact on the property market, but also the materials. Getting the materials in. And the wait periods of just getting windows and various other materials are taking 12 weeks in some of the projects of my students. So that has an impact as well on getting the economy moving. So there's just not one little factor that impacts the property market. and the investors itself.
So, so Paul, I'm going to bring Paul in on this one, because obviously we've spoken about inflation, we've talking about materials being an issue for construction. What other changes has the pandemic and the wider economic milieu brought to the property industry, would you say?
I think it depends on what perspective you're looking at it from. Bindar quite rightly just mentioned there about, as a property developer, it's a much more difficult market now than it was 12 months ago. The cost of materials have gone up probably 30% on average, and some things 100%. But that's from a property developer's perspective. If you're looking at it from a buy-to-let investor's perspective, actually it's quite a good market. And historically, in high inflation environments, property prices increase at a higher rate than inflation. So property as an investment is actually quite a good hedge against inflation. It also depends on what locations we're looking at as well, because I think a lot of people, especially that live in London, think about London being the only place in the UK, and it's obviously not. But London is the most unaffordable place in the UK. So inflation is going to affect London the most, especially when you look at the fact that the average wages versus rents versus property prices, it's already super unaffordable. That's not so much a problem in other cities across the UK, and therefore that they will be affected less.
Yeah, no, it's an interesting point. It does depend on sort of where you sit in the market, doesn't it? I want to bring Ben in on this one then, because obviously, Ben, your specialty is in mortgages. So from where you're sitting, what are the biggest changes to the real estate market brought on by the pandemic? I suppose, what does all this mean for mortgages at the minute?
Yeah, the first place I'd start is this is probably the hardest time to forecast and predict that I can remember. Barring maybe the credit crunches, sort of 2007. It's a very hard time to forecast. What I will say is if we go back to the start of the pandemic in, was it March 2020, there's a huge amount of negativity, in particular from banks and property experts forecasting dreadful unemployment. Everything's super negative in terms of house price deflation, and all of us remember that very well. At the time, graphs changed, consumer sentiment changed, as you alluded to in the beginning. People who are fortunate enough to stay in employment and have money, maybe a bit of equity and certainly savings, then prioritise where they lived. And along with the stamp duty break, we saw a huge increase in property activity, which is still running. And most experts would look at the graphs and what was happening with COVID and say, why on earth is that happening? It still happens today, because if you look at, interestingly, consumer confidence graphs, consumer confidence is down very quickly and significantly as well. And now, historically, if you look at the consumer confidence graphs, if they're as low as they are at the moment, you see housing activity and certainly demand for housing significantly decrease. We are not. Demand still outweighs supply significantly, even though supply is very low. And I know that's a real problem at the moment for asset prices. If I'm a first-time buyer, for example, it's becoming increasingly expensive. But what we're seeing is that level of sort of that change in consumer behaviour sustained, because if I've been in property for the last 2 years and I want to move house, my house price has gone up double digits for sure, pretty much everywhere in the country, irrespective whether it's south or north or east or west. Everyone's seen asset prices increase. If I stayed in employment, I've saved a lot of money. So if I now refer, for example, to the cost of living crisis, which I completely acknowledge is a real problem for many, many people, if I'm fortunate enough that my property's gone up 15% in the last 12 to 18 months and I've saved a lot through the pandemic, whilst it's annoying, I don't particularly care. I'm still going to move if I want to, because I've saved that money and I've got housing equity. So what we're actually seeing is a polarisation, or further polarisation, of the fortunate and the unfortunate, in so much as if I'm an existing homeowner, I can move because of that. And then the final bit we're seeing, which is quite pronounced at the moment, is first-time buyers. We've seen more of a surge in home movers, so subsequent movers, in the last 18 months than first-time buyers. And that's been the real growth segment for the reasons I've stated. The only exception to that is people are buying with parental assistance. So the intergenerational deposit gifts from parents and occasionally grandparents. Now, again, that further polarizes the sort of the haves and have-nots, because if I'm lucky enough to have wealthy parents or even grandparents, then I can probably put down a chunky deposit on my first home and afford to buy my first home. So those are some of the sorts of changes we're seeing at the moment. And as of literally, right now, we're still seeing activity strong. And the very final bit I'd say is long-term housing transactions housing transactions today are only at the level of long-term averages. They're not significantly beyond. A lot of the commentary in the press seems to indicate that we're in some sort of a boom phase. We're actually on the long-term average.
We are getting some questions coming in from our audience. So I'm going to direct these to whoever feels best placed to answer them. One person was asking, how high do you see interest rates going? And then do you see UK house prices entering 4 to 5 years of price falls, falling 20% from their peak? It's obviously an interesting question, because I think Savills forecast a fall in house prices for next year. So I don't know, who wants to take on that one? With interest rates, are we going to see house prices falling from where they're at the minute?
I'm happy to jump on that one. I think no one would argue against interest rates increasing from here. It's going to happen. It already is happening, and that will put some pressure, especially on. I was going to use the same term there of the have-not. Not so much the have-nots, but people who are already struggling to afford their mortgage. That extra bit of cost will start to affect them. But if you look historically at the way that property prices have performed, we've never had a 4 to 5 year price decline, ever, to my knowledge, unless it was a very, very long time ago. Generally, when property prices decrease, it's over a 12 to 24 month period. And then it starts to recover. Now, in my view, depending on how you're looking at property, or I believe we're talking about investing today. So generally from an investment perspective, that doesn't really matter if you're in it for the mid to long term, which is what you really should be in it for. Because even if we get 10, 15, 20% price decline over a sort of 12 to 24 month period, so long as you're in it for a 5 to 10 year sort of time frame, you will get that back and some.
And it would only take us back. It would only take us back to where we were, say, 18 months ago, Paul, wouldn't it?
Exactly. We've had strong double-digit growth for the past 12 to 18 months. If we lose that, it's not the end of the world.
Exactly.
I'm going to bring in Manira. Sorry, because I'm going to bring in Bindar, because she's been trying to talk, and then going to go to Ranjan.
No, what I was going to say, but we haven't had a proper interest rise for considerable amount of time. So we knew this was coming, and we had really good time. Property investors have had a really good time, especially the new property investors. They've never seen really the interest rates like some of us. A little bit older, I would say 15%. I remember buying my first house, interest rate was 15% in the 80s. So even if the the interest rates are going up, we stress test our investments and to make sure that the deal actually works. And so stress testing, and also just like what Paul said, why are you investing in property? What is your strategy? Is it for the short term or is it for the long term? And where are we in the property cycle right now? So it's actually making sure that we all have a plan before you dive into the property and getting that and seeing which area will support you for your strategy.
If you don't mind me just adding slightly on the end.
Well, I'm just going to jump to Ranjan quickly. I feel like he's been trying to get in on this one. So, Ranjan, on the thoughts of sort of interest rates and what it might mean for house prices.
Yeah, I think interest rates. I think the key thing that people are missing here is that it's never been so cheap. The thing is, the only way inflation is killed is by interest rates being higher than inflation. There is no political appetite to do that. And in the past, when people talk about we've had spikes of 15% interest rates, that was designed to kill inflation at the rate of 10%. We've never had a situation where the interest rate, is 1% and real inflation is 10%. Money is massively cheap. Even if interest rates were to go up to 3%, it's still much cheaper than inflation. And that means for property investors, if you buy a leveraged asset, you fix your debt on a 5-year fixed rate and you're making real positive cash flow, then that money, the cost of that, the value of that money that you've borrowed is going to get cheaper and cheaper over time. Because there doesn't seem to be the political appetite to set interest rates at above inflation in order to kill it off. So that's a real opportunity for people.
Yeah,
Ben, go on, Paul, real quickly.
Yeah, I was just going to come in on the agreeing with all those comments. It's just going to come in on a supply-demand point as well. Obviously we've been desperately trying to build, 300,000 new units a year for some considerable time. I go back to various reports in the early 2000s where that became an objective and a KPI to measure it, never got delivered and still hasn't. We've got a massive property supply imbalance with demand, which remains incredibly strong. So even if we do see a flattening off in prices in the next sort of 6 to 18 months, which personally I expect, it just feels a logical thing. I don't see a big crash because of that point on supply and demand. And also, it's probably not a bad thing. It brings more first-time buyers in, potentially more investors if we see a flattening off in prices. And it's a natural adjustment to what's very real around us at the moment. So if we look at the measures on supply, I do think that's a big factor. We don't have enough on the market and demand significantly outweighs supply right now.
We've spoken a lot about inflation, which is obviously perfectly fair because I imagine it's top of everyone's agenda at the moment. But we do have a question specifically about COVID. Someone said, with respect to the property market, any thoughts on implications with respect to remote working as a result of COVID? So has that had any impact on the property market? I'd be interested to hear everyone's thoughts on that.
Yeah. Look, it certainly had a short-term impact. Whilst everyone was working from home, cities were very quiet. However, pretty well all of the data now indicates that things have either returned to normal so far as demand in city locations, or even got slightly stronger. Now, that seems a little bit illogical, but from what we've looked at, it seems to be that because although people are still working from home a little bit more than they did in the past, maybe 2 or 3 days a week, at the very least that they're still having meetings in central locations. So they're still having to be close to those areas. So from what I've seen, it hasn't had a huge we're not long term from it now anyway. What are we, 2 or 3 years since COVID first came about? It certainly doesn't seem to me that people have left central locations, as was indicated in the press at some points.
Bindar, what do you make of that? I mean, how do you think working from home and this sort of our changing attitudes towards remote working has affected the property market, if at all?
Definitely in London, during COVID, there was more empty houses, rooms, because people didn't have to be in the city. And now, just like what Paul said, was people are returning back to work and actually quality of life as well. So they can work, they can adapt, working part-time at home, part-time at work. So it's having that quality of life, more demand on houses, and with areas, parks locally or communal areas. So if it's flats, communal areas, that's what I found. And also the rentals have gone up as well. Supply and demand again, there's less properties, depending on area, of course. Well, I'm talking area Pacific. The rents have gone up in certain parts of London and in the outskirts of the M25, because there's not that many properties. Letting agents are desperate for properties to take on, So again, it goes on supply and demand. And yeah.
No, it's interesting. I mean, I think there's obviously a lot of bullishness from the from our panel here. I did just want to bring someone's comment from the audience. They seem to have a much more conservative take. They said that the real concern with property decline is not just the aspect of a declining asset, or I suppose that's referring to property prices, but rather, and much more importantly, what this will do for our consumer confidence. So, where are we in terms of demand? I know we're talking a lot about demand's never been higher, but I know there was, I think the Financial Times put out a story recently about estate agents reported a net drop in demand for the first time in several months. So where does that put that sort of confidence in people's ability to buy homes? Where does that sort of put the market?
Yeah, so I'll take the first view on that if I can. Just basically looking at data, yes, demand has fallen off a bit in the last, I think it's 4 to 6 weeks roughly. But if you look at the sheer level of demand versus supply, it so significantly outweighed supply for the last 24 months pretty much that of course it was going to come off at some stage, but you still have a pronounced imbalance between the two. Now, interestingly, picking up the COVID question, linking that to this one, there's 6 areas that really kicked demand up from the start of the pandemic onwards, and that's: I want to be out of the city. I don't want to work there anymore, so I don't have to come there. I want a home office. I work from my upper floor or garden room or whatever it is. Divorce has pushed the numbers of demand for new houses up. I want to have a second home, the fortunate few, and buy-to-let has become attractive as well. And I want a garden if I lived in a flat in London, for example. There's 6 big things that have driven this. Now, interestingly, what's happening at the moment, and I can only speak for a few employers I know, is there's quite a few brave employers trying to get people back to the office. So what's driven that demand in the last sort of 24 months, i.e. working from home pretty much or up to 3 days a week, there's a bit of a change coming at the moment in some areas with some employers. And what I don't know is what that's going to do for those 6 factors I referred to as we look forward into the next 3 years, for example. But what I can say, notwithstanding what Savile said and others, demand is still incredibly strong, and it will carry the number of transactions forward at a comparable rate to what we've seen in the last 6 months for some time to come yet.
I think if we talk about consumer confidence, consumer confidence, obviously that does have an impact, and that's perhaps why there has been a bit of a drop-off in transactions recently. You look at certain things that are happening around the world and inflation and all that sort of thing. But consumer confidence is a very short-term way of looking at things. Property is a mid to long-term investment, and consumer confidence is relatively fickle and can change overnight. So I don't necessarily think that's too much of a concern, because if you're buying good properties in good areas that are very easily rentable, then it doesn't really matter if prices drop off a little bit over the next year or two, because then it will come back, as we've said before.
Yeah.
I'm going to change the topic somewhat, just because I've had 2 very interesting questions that are quite specific, but I think Ranjan might be best placed to answer them, considering his expertise and his YouTube channel. So one of them was, we've got a small buy-to-let investor in the audience. They currently have just 1 buy-to-let property, but they're looking to increase this. They're asking, does the panel, I'm going to start with Ranjan, we can go to others as well, does the panel recommend setting up a limited company or just investing as a person? Ranjan, I don't know if you've got any thoughts on that.
I think it's changed dramatically over the years. If you're looking at doing buy-to-let or property investing as a business, you're looking at doing more than one, and you are in the 40% high rate tax bracket, then it's an almost dead cert that you should be thinking about doing it in a limited company. The mortgage rates are pretty good these days, and that will allow you the maximum flexibility. I think we are fast moving to a stage where people in buy-to-let have to be doing it. You have to go big or go home. The opportunity to just have 1 or 2 buy-to-lets and do it in a tax-efficient way is increasingly getting very, very limited. So you've got to really be looking at building a reasonable sized portfolio, 6 or more, over a period of time. And if you're going to be doing that, it's going to be a limited company structure for most people. That's just a rule of thumb.
Anyone? I don't know if
this is a big part of what we do, really, from a strategy perspective. And I agree with what Ranjan said. They need to be a little bit careful, given that it kind of does go into tax advice region, and this is we're talking in general here. But generally, the rule of thumb is that if you're a higher rate taxpayer, you're slightly better off with a limited company, and if you're a basic rate taxpayer, you're better off having properties in your own name. Now, sometimes there's a way around that, in that if you're a couple, sometimes you've got a high income earner and a low income earner, and therefore maybe you're better off having properties in your partner's name, or at least having them as the beneficiary of the income of those properties. But I'd say probably about 70% of our clients that are investing in buy-to-let, especially for new property purchases, are doing so through limited companies.
Binder, do you want to comment on that as well?
Yeah, I was just going to say it's a very complex topic, and it's very specific to the person and what their long-term goals are, like both of Paul and Ranjan just said, because it costs a lot of money to actually set up as a limited company and to run it if you've already got portfolio incorporation. However, having a plan of action, knowing where you're going, buying, is it just one property, then maybe in sole name. Otherwise, it's building a portfolio.
No, all very valid points, and you can see the panel is mostly in agreement on that. I'm going to bring Ben on another question that I've got from the audience here. This one is about mortgage repayments specifically, so that's kind of why I wanted to ask it to Ben. One person was asking about the current energy crisis, and it's going to last well into 2023. This person saying, with that in mind, where does that leave first-time buyers with regards to their sort of mortgage repayments? Ben, I don't know if you've got any thoughts on that.
Yeah, I mean, quite frankly, I think the reason we've seen a slowing down in first-time buyers is twofold. Basically, one is prices have got to the point where, unless you've got parental assistance, you're saying that's probably too expensive now, I can't leap that high. And we've definitely seen an element of that. And I think the second is exactly what the question is hinting at. The cost of running a home is significantly more than it was, and first-time buyers notoriously are a bit more stretched. I think some of the encouraging noise is to take a slightly different tack that are being considered, and I'd underline the word considered at the moment, are how underwriting and the assessment of current renters as potential first-time buyers can be appraised in the future. They're very keen, the government, to unlock current, what I call reluctant renters. So people who want to become first-time buyers, and some of the areas they need to look at would be, for example, what they're paying in rent at the moment, and then transpose that onto a mortgage payment and see if you can underwrite more generously there to enable them to buy their first homes. Now, whether that comes to pass, I don't know, but there's a real frustration that people are buying their first home at 35 now, roughly, depending on which part of the country. It can be more, it can be less. And there's something needs to be addressed there. So this review of the market that Boris announced, which is going to be announced in the autumn, will look at things like that. But for now, I think I would expect to see a continued slowdown in first-time buyer demand because of the factors we're talking about, and that's asset prices and affordability.
I've got another question, which I think is quite an interesting one. This is for the sort of the property investors on our panel. One person, and I'd be interested in this as well. One person's asking about real estate investment trusts. I assume they mean those ones listed on the stock exchange. Are they a better alternative to direct property investment? Ranjan, do you want to give my...
I think it all depends on your own position and the time that you want to put into it. If you haven't got the time to put into educating yourself and learning property yourself, then of course real estate investment trusts offer a done-for-you solution. But if you are interested in property investing as a business and you're looking at learning the skills to be successful at it, you will always, provided you have the right strategy and everything like that, you're likely to outperform real estate investment trusts if you go it alone, if you put in the effort and you're good at learning the skills to invest and actually implementing them. So it depends on the time and the aptitude you have for investing in property. The people I work with and my students actually are passionate about doing it and passionate about developing properties, investing in properties and finding their own deals. And that's the whole fun of it. That's the whole passion of it. So if that's you and that floats your boat, then learn the knowledge and make your own investments. But if you're time poor but want to be involved in the sector, then that's the avenue for you, real estate investment trusts.
I'll give my opinion on that.
I feel like Paul's been trying to jump in. Sorry.
If you look at the returns from REITs or real estate investment trust versus buy-to-let, for example, REITs give very similar returns to the share market. You're looking at high single-digit, low double-digit returns. Ranjan's exactly right that it's a done-for-you option, and it's usually quite well diversified. So you could say it's less risk because it's unlikely to fail, but it can still fail. Whereas with buy-to-let, the biggest benefit of buy-to-let is the ability for leverage. So the fact that you can take £50,000 and buy a £200,000 property by generating relatively average returns on that asset, you can get really strong double-digit returns on your cash, somewhere between 20 and 30% per annum on the cash you've put in. So that in my mind, that's the biggest difference. And that's why direct sort of property purchase is a better option, because the returns are much better.
Sorry, Bindar, I'm going to bring you on this as well now.
Yeah, I think it all depends on what your long-term goals are. It's the finding. Are you prepared to put the time in? If not, then it's as both of the guys said, it's a done for you, the trust. But it's about your long-term goals, and buy-to-lets and HMOs that I specialize in. You buy the right property in the right area for your strategy and your goals can definitely outweigh the trust, depending on obviously how much you buy the property for, and you get a continuous return on your investment and leverage from it, and pulling money out and investing in further buy-to-let portfolio. So for me, it's about, are you prepared to learn the skills to go out and do it yourself, or then get somebody to source your property but know what you're doing? Because those days are gone where you can buy a property and hope for the best. And it's also about the location as well. And what type of tenants you're going to put in them.
I'm going to ask you another question, Bindar, just because we've got one from the audience, which I think is relevant to you. They say, and I don't know if when they say experts in this question, I don't think they're directing it at the panel. So I don't know if this is the panel's view, but someone's saying, why do the experts, don't know who the experts are, still give so much importance to house prices? To my mind, it's an obsession that needs to be curbed. Surely cash flow is the main thing that matters, is it not? Capital gain is always a speculation and is only relevant when flipping. Bindar, I don't know if you have any thoughts on that.
Cash is king. It's definitely, cash flow is very, very important. And that is why, depending on whether you buy buy-to-lets or HMOs is more time intensive, and it's more rewarding and gets more cash flow for you, and depending on what income you want. So definitely capital appreciation is fantastic, but then the question is, are you buying for income on a monthly basis, or is it for the long term? You don't need the money right now, but you're going to be building up your portfolio and you want capital appreciation. So it depends on your strategy of income or capital or both, and that will divert you to which area you would like to invest in, depending on how much money you've got as well. So yes, cash is king. for sure. And I always focus on the cash flow, and the capital appreciation is a bonus.
I'm going to I'm going to use areas to try and make a kind of segue to the next question. One person was asking about areas, geographical areas, which areas within the UK have the best potential for growth over a 5 to 10 year period in buy to let. I'm going to ask Ben this question, but I'm going to slightly tweak it because I know Ben's expertise is slightly different. But Ben, in terms of mortgages, where are you seeing sort of house prices rise the fastest in the UK? And how does that affect the mortgage broker market?
Yeah, so to kick off a series of answers on this, on the residential side, the last 2 years, we've not seen, London lead the way, for reasons I think everybody fully understands. That may or may not change in the near to medium term, but what we've particularly seen, or where we've seen particularly pronounced growth is the home counties, but also, places like Devon, Cornwall, Somerset, parts of Yorkshire. And I could go through a list of places where people have been buying second homes, where again, the demand significantly outweighs supply. But it's not by region, it's not by county, it's almost by area. Because you can go to pockets in Yorkshire or Cornwall or Devon or Somerset, and just down the road from a particularly desirable place, prices haven't done the same thing. But if you look at a heat map, my general answer would be the real growth has come outside of London. And it's in reflection of some of the factors I was pointing to earlier. It's for reasons of people wanting to come out of cities and go more into sort of the countryside, if you like, and more desirable areas. And that's where we've seen the real growth, and also areas that maybe have been undervalued a bit in the last 10 years.
That's quite interesting. I mean, just as a quick follow-up to that, you were talking about how you get these pockets. Let's take London specifically. Sorry to be London-centric, but I'm just interested because it's where I currently am. Where do you see these pockets then? So London is seen as maybe this area where the house market, actually the property market in general, perhaps is overheated just a tad or quite a lot, depending on your opinion. But where are the pockets of sort of growth in house prices in London, would you say?
Yeah, so again, what we would see is it's what I call, if you think of it as a dartboard, the bits that have been affected the most are, the bullseye centre has seen the withdrawal of a number of different types of foreign buyers over the last few years. In particular, it's taken some of the demand out. So people who've also bought in that central part of the ring of London, if you like, there have been very high valuations the last sort of 10 to 20 years. They've cooled off significantly. Now, that may or may not come back. And you might have to take a series of things to change that. But if you go around sort of the very outer ring of that dartboard I describe, and if you look at, Barnet down to Clapham, and so from a north-south perspective, then out into the home counties, those are the areas where you've seen people come out of London by still in relatively close proximity to what I would describe as a commuter belt, but they have countryside on their doorstep. So, I'm in Hertfordshire just now. Hertfordshire has been very, very strong. And I know it's the same for counties close by. And that's where we've seen the real push. And the question mark for me, and I don't know the answer, the panel may have a view, is if we're hitting this inflection point of, I want to get people back to the office a bit more, maybe 4 days, not 2. Look at Elon Musk's approach, which was typically brash, wasn't it? Get back to the office was the message. If that becomes the way, and let's say the path of COVID continues to be relatively benign, it could just be that London comes back again in the medium term, because it's still an incredible city. And if people are increasingly going back to work there, you may see that dynamic on house prices change. But the panel may have a view on that.
Well, yeah. Well, let's bring the rest of the panel in then. So let's start with Ranjan. I mean, which areas in the UK do you think have the best potential for growth from a buy-to-let perspective over, say, a 5 to 10 year period? And what about London? Will it come roaring back as a place to invest in buy-to-let property?
Two separate questions. I'll tackle the London one in a moment, but I don't really advise people to chase hotspots for capital appreciation. What you end up doing is, over time, building a ragtag portfolio of properties dotted around all over the place because you've chased hotspots. You should look at geography, where you live. You should look at, you can always, wherever you are, you can make money in your own backyard. If you can't make money in your own backyard in property, then why do you think you can make money 300 miles away from home? there are always extra costs in keeping property or holding property that's miles away. So I believe there's always opportunity. I've always found opportunity within an hour or an hour and a half commuting distance of where you actually live. And I think the thing to invest with now is not for capital appreciation, because capital appreciation is uncertain. I haven't got a clue when capital appreciation will happen. I know it will happen one day because we all invest for the long term, but the long term doesn't put food on the table today and doesn't help you meet your own personal cost of living crisis today. What puts food on the table today is cash flow. So what I do is I'm investing in property, I'm investing in leveraged buy-to-let properties, which I'm buying today, fixing my interest rates for as long as possible, because I know today it's producing positive cash flow at the end of every month. And that's what I can actually use. Now, the long term in property broadly sorts itself out. If you have got positive cash flow at the end of every month, that is what matters today. That's what you can spend, that's what you can invest. And in property over the long term, the capital appreciation aspect will broadly sort itself out. London is just a sleeping tiger right now, because what you've got to bear in mind, yes, there's not much capital appreciation happening in London, and buy-to-let yields are dismal. There's no case for investing in buy-to-let in London if you're just getting 3% yield. But the capital appreciation case is over the long term, because think about it this way. Take £100,000 of money. If you've got 10% inflation, over the next 5 years, £100,000 of money is not going to be that much. £100,000 worth of money is going to be £50,000 today. So if everything else goes up, how can a £100,000 property stay at £100,000 price in 5 years' time? Inflation has to take its course. It won't keep level with inflation, but at some point it will play catch up. So if you look at the stats for London, it tends to do nothing for several years, and then there are a few years where it's double digit. When that will happen, I don't know, but at some point in the next 5 years, definitely.
Yes,
sorry. If I could just add a little bit of variety into the end of that question. In that, although our head office is in London, we don't invest in London. And I think it depends on your strategy. Ranjan is quite right. And Ranjan being a good friend of mine, I know that he gets a nosebleed when he goes north of Watford. So, we're very focused on places like Birmingham, Manchester, Liverpool, other major cities outside of London. But most of our clients and ourselves predominantly are more passive investors. We're not well. I do a bit of development myself now, but most of the time our clients are buying properties to rent them out, and they want them to pretty much look after themselves. Now, if that's the case, sometimes there aren't good buy-to-let opportunities close by where you live, especially if you live in London. So in my view, certainly, and when you look at the growth stats, Birmingham, Manchester, Liverpool have been at the top for the past sort of 3 to 5 years. And there's good reason for that, due to strong infrastructure spending, job growth, all the rest.
Paul, I want to ask you a sort of follow-up question. It's related to one of the things we were talking about earlier with regards to REITs, because we've obviously now got large, Granger, I don't know if that has become a REIT or whether it's going to become a REIT or something like that, but and many other large corporates are moving into the build-to-rent market, and they're muscling in, and they see it as an opportunity that so much of the buy-to-let market is sort of smaller time investors. So one person asks, will there even be a place in the market for the smaller buy-to-let investors as more of the corporates, whether that's private equity corporates or REIT corporates, kind of muscle in?
I think going back to what was mentioned a few times before about supply and demand, and the fact that COVID has significantly slowed down supply. Well, we already had a bad supply problem before COVID, and now it's even worse. Demand is so heavily outweighing supply that these big corporates that are building a few thousand units, that doesn't go anywhere near meeting the supply issue. So yes, I believe there still will be a place for the smaller investor. But again, it all comes back to location. There is no such thing as the UK property market from an investor's perspective. You can't invest in the UK property market. You can only invest in individual properties in individual locations. And you should be investing in locations where there is extremely strong demand for the types of properties you're buying. And if that's the case, and they're very easily rentable, then it's quite a safe investment, regardless of other competition.
No, it's an interesting point. Pindar, are you going to come in on that?
I was just going to add on to that. It also depends on your risk profile as well. And like Ranjan's already mentioned, how far away do you want to travel for your investments? So it's all about, do you want to be hands-on or hands-off? If you want to be hands-off, which area can support you with that strategy? My students are investing for income, and they're going all the way up 4 hours drive to Middlesbrough, but there's a system there, there's social housing, so it depends. And also Birmingham is a great one for social housing. So what is your demand? And also diversification and having a mixed bag, that if something happens to the social housing market, then you can put other type of tenants in there. So it's risk management as well.
No, it's an interesting point. I mean, I did want to just ask a quick another question from the audience as well, Bindar, if you don't mind, with regards to, and I'd be interested to know what you're talking to your students with regards to this question. But someone was asking about climate change and sustainability and the extent to which properties have to be sort of modified to become more energy efficient. I know there's a change in the energy performance certificate requirements coming down the track. So what are you telling your students about this, and how can they sort of navigate that in their portfolios?
Well, sorry, is this question to me?
Yes, it was. Sorry, yes.
Oh, yeah. So yes, there is talk about that's changing. The EPC from used to be I think it was 2007. EPC rating has to be D and above. E and above, and then now changed it in the sense of bringing it in to C and above. So it's all upgrading the properties and using that as leverage to look for either new properties, not new builds, but newer properties which are energy efficient, or looking for opportunities where you can buy the D property if it's a band D, and how can you upgrade it to a C with putting minimal work into it, because sometimes it just needs cavity insulation, new windows. So what can you do to bring that property up to scratch and without having to put a lot of money into it? So I've been advising, looking for, there's always an opportunity in when rules and regulations change, but it's being adaptable and working with the change.
I think it's worth really,
well, briefly, very quickly, very running out.
One of the top builders we met with recently was just citing the fact that their biggest growth segment for buyers of new homes is the landlord at the moment, because of the energy efficiency rating aspect. And that's an interesting one because that competes with first time buyer, and it is a real time changing dynamic as well.
Yeah, no, absolutely. I think it has the potential to completely change the market. I'm really going to have to stop, Robin. I really apologize. I'm sure we could talk for hours on these topics, and the questions keep coming in thick and fast from the audience as well. But I just want to take this moment to thank the panel for answering so many questions. My questions, but also so many of the audience questions. Thanks to the audience for giving so many questions, and thanks to our sponsors as well. But yes, thanks very much for joining us, and we will see you next time. Thank you very much.